Welcome to Talk Tickers. Today we're diving into the AI infrastructure firm Blaize, ticker BZAI. And folks, what we've got here is a classic Wall Street story, a tale of two completely different realities. We're calling it the Great Divergence.
See, on one hand, you have the market's verdict, which has been absolutely brutal. A 78% drop over the last year. Just ouch. But on the other hand, you have the company's management telling a very, very different story.
The CEO himself, Dinakar Munagala, came out and said Q3 was a breakout quarter for Blaize. So, what's going on here? How can a stock be in a free fall while the CEO is calling it a breakout? That is the core conflict, the great divergence we're going to unpack for you right now.
Okay, so let's get right into the numbers from their earnings call on November 13th. We got to figure out what's fueling this massive disconnect between the company's story and the stock's price.
Now, if you just glance at the headlines, everything looks great. It was a clean double beat. Revenue came in at $11.9 million, a little bit ahead of what analysts were expecting, and their loss per share was actually 5 cents better than expected. So on paper, a solid report.
And here's where it gets really eye-popping. That revenue number? It was up almost 500% from the quarter before. That's an explosive jump, and it's all because they finally started shipping product on some of these huge contracts they've been talking about. This is the breakout the CEO was so excited about.
But, and you knew there was a but coming, here's the catch, and it is a huge one. Their gross margin absolutely collapsed. It cratered to just 15%, all the way down from 59% in the prior quarter. So what does that tell you? It tells you that all this new revenue is coming at an incredibly high cost. They're basically buying growth.
Now, to be fair, it wasn't all bad news. They did show some discipline. Their adjusted EBITDA loss actually got a little smaller, and they kept their operating expenses flat, which is good to see. Plus, they raised about $30 million in a private placement, so they've got over $60 million in cash. They bought themselves a little more time. So how in the world does management explain this strategy of growing so fast while margins are getting crushed? Well, it all comes down to the story they're pitching. Let's look at that story versus the, substance of the financials. They're trying to carve out a niche they call practical AI. The idea is they're not trying to compete with the giant cloud AI companies. Instead, they're focused on real-world infrastructure projects, a lot of them with governments, where things like efficiency and keeping data in country are way more important than raw speed. And this right here, this is the whole story arc they're selling to Wall Street. They're saying, look, in the past, we were contract-rich, revenue-poor. We signed deals but didn't ship anything. Right now, in the present, we're deployment-rich, margin-poor. We're finally shipping, but it's costing us. But the future, they promise, is becoming scalable and profitable. The whole bet hinges on that question mark at the end. Can they get there?
So that's the pitch from management. It's a classic Jam Tomorrow story. But the market? Well, the market is deeply, deeply skeptical. And you can see why in the charts.
Just look at this. Even with that so-called earnings beat, the stock is down almost 40% in a single month. Meanwhile, the S&P 500 is up, and the tech sector is up even more. This shows you there is a serious, serious lack of belief from investors. They heard the story, and they are hitting the sell button.
And this slide really boils the whole debate down. The bulls are hanging their hats on that big revenue beat, some really aggressive guidance, and a pipeline of over $700 million in their little niche. But the bears, well, they can't see past that massive margin collapse, the high cash burn, the constant risk of them selling more stock to raise money, and just a ton of uncertainty about whether they can actually pull this off.
All right, so with all that on the table, where does that leave us? Let's talk about what they're guiding for next and what our official take on this stock is.
And wow, management is not shying away. They are guiding for revenue to nearly double again in the fourth quarter. And they're sticking to their super ambitious target of over $130 million for 2026. They are doubling down on the growth story big time. But for us, despite that incredible top-line story, the risks are just too big to ignore. The path to profitability is incredibly murky, and they're going to need more cash. That's why we are initiating coverage with an underperform rating. The story sounds good, but the underlying financials just don't back it up yet. So here's the trade idea. The thesis is pretty simple. We think the market is going to keep punishing this stock for its terrible margins and high cash burn, no matter how much revenue they report. So the action would be to short the stock on any pop, especially if it gets near that $3 level. Our target is $1.50, a price where we think they'll almost certainly have to raise more money, which would hurt the stock even more.
The big risk here? They announce another monster contract, or they somehow fix their margins way faster than anyone expects.
And really, it all comes down to this one question. Can Blaizes actually make that leap from margin poor to scalable and profitable before the clock runs out, before the market completely loses patience, and more importantly, before their cash pile runs dry? That is the billion-dollar question that will decide everything for this company. This analysis is for informational purposes only. This is not financial advice.